Overall, the Dalal Street clocks gains for the week. The Nifty and the Sensex add about a percentage point each, rising for the second straight week. Financials underperformed, giving up half of last week's gains. On this week's edition of Editors Roundtable, we take stock of the week on Dalal Street. We put the spotlight on IT companies and decode why there may be a big shift from capex to consumption. And we'll also tell you about China's exports to the global market are growing at a much faster pace than US and Europe. I'm Reema Tendulkar. With me are my editors Prashant, Nimesh and Nigel. And joining us today on the show is Harish Bihani, Senior Fund Manager at Kotak Mutual Fund. Hi, guys.
Yeah. Hi. It was actually a good week, but not a great end, right? Otherwise, it was good till Friday morning. But otherwise, I think, the close wasn't great on Friday. Otherwise, the week was pretty okay. We outperformed after a while. And
relatively a good looking screen from the broader markets, right?
Yeah.
They're actually outperformed.
Yes.
A lot of individual names are buzzing in. And across sectors, we've seen, a lot of stocks rallying 15, 20, 30%. So in a way, it was a good week. From a broader market perspective, there was a bit of participation.
But very disaggregated, right? No common thread, no sector. Really very, some this, some that.
I think next week's a big one, right? You've got the 50% tariffs which come into effect if there is no change till then. You've got a truncated week. Wednesday is a holiday. You've got the Reliance AGM. So that's on Friday, 2 o'clock.
And the Prime Minister is in China for that summit, SU summit.
And then there's a Q1 GDP print as well from India. That we'll be tracking. So I think the next one's a big one in terms of news.
Yeah, I think, in terms of market positioning as well, this market is net short, so that's always giving you some kind of hope, because if you look at it, the FI net short positions came down by 10% in this week itself. Bit of short covering bounce. And mutual funds are sitting on ample liquidity, right? 5.7, 5.8% as of the last count. So equity, cash as a percentage of the equity AUM as well. Pretty high and pretty comfortable in the system. But one of those people who are sitting on that is Harish Bihani, who joins in. Hi, Harish. Good to have you on the show. How are you feeling about the markets? Mr. Trump is not showing us too much mercy, at least as of now. Trump's tariffs are a bit of a sticky point. But on the domestic front, there are moves being made, right? Both monetary as well as on the fiscal front. How are you feeling about the Indian markets?
Thanks, Nigel. You're right that in terms of how the overall domestic economy is shaping up, we have seen some kind of tailwinds in the last few months. You've seen fiscal and monetary policies being supportive, which should help with incremental growth, especially in the second half of this particular year. Nonetheless, we are not still out of the woods. There are several headwinds too. When you look at the public capital expenditure that was fairly middling last year, hopes that will improve in the second half of this year, but we are still uncertain. Private capex has been middling for last many years now. We all had hope for an improvement, but it's not happening. Export remains weak given the tariff uncertainty and many other uncertainties across the world. And consumption is the only hope which is left right now. With the supportive fiscal and monetary policies, the hope is that second half of this year we'll start seeing better consumption, which should also flow through to next year, given many changes happening this year will also percolate to next year. So large part of how markets are shaping up is to look at pockets where earning growth and earning certainty is high, and which is where sectors like consumption is taking a forefront. Apart from that, certain other specific sectors like healthcare, which always does well, is taking a forefront at this point in time.
Harish, you want to just quickly tell us how you would position your portfolio at this juncture?
Right. So I manage multiple funds for the business cycle fund, which I do. We are significantly overweight the healthcare sector, and significant means significant consumption. And when we say consumption, we are very selective on staples. We are significantly overweight the discretionary consumption side. We are significantly overweight a couple of the internet names, and significantly overweight. And we are significantly overweight the auto sector, pockets of industrial sector, pockets of infra sector, where we see tailwinds incrementally, both in terms of earning cash flow, not only for the next 6 months, but beyond the next 12 to 24 months.
All right, Harish, I'll tell you what, since you spoke about consumption, Nimesh is going to be putting a nice piece, whether that shift is taking place from capex, just till this budget, everyone was thumping the table about capex. Now, suddenly, post what's happened in the budget and post the GST rationalization, the attention has turned to consumption. So we'll get to that in just a bit. But for the time being, we have our tech expert with us as well. Rima is here. Rima, tell us, there's an interesting note that's coming from Citi, I think.
So one sector that Harish didn't speak about was, technology.
Because he's going to speak about it now.
We're going to ask him. But, there was this one note by Citi, which I found interesting, right? We keep saying that IT is struggling because of the global macro. And typically, there was a very strong linkage between how IT companies would do and the S&P 500 companies' earnings. But this time, that link seems to be broken, to which Citi says that it's largely because S&P's earnings are driven by the Magnificent Seven. If you strip that out, the earnings have been, the earnings of the rest of the pack have been a bit struggling. The next question they ask is that, is IT spending, is tech spending really weak? Citi says not entirely. Banks' spending, proxy data shows a 7% year-on-year growth. Hyperscalers, that's your AWS, Azure, Google Cloud, etc., have seen a 27% year-on-year growth in the last quarter. So in a nutshell, it's not that global IT spend is collapsing, it's just not finding its way towards Indian IT. So the question is, why is Indian IT then sluggish? Why is money not coming to Indian tech? Well, client budgets are prioritizing AI, but services firms are yet to see a big revenue from AI. The new AI work is still very small. There are productivity pressures on account of AI. So clients are asking you to do more with less money. There is that deflation, and GCCs are also taking away some part of the pie. So which is why there is global tech spend, but it's just not coming to Indian IT. And particularly for Indian IT, from a stock market point of view, revenue growth is likely to be subdued for the third consecutive year. Margins, therefore, are under pressure. There's rising, competition from GCCs, AI productivity. They need to invest more. On valuation, Citi says the Nifty IT index has underperformed the Nifty by 24% year to date. But from here on to grow, you still need clarity on growth coming back, and that is not visible yet, which is why Citi is a bit cautious. So some, interesting, ways to think about the global macro, the global tech spend, and why Indian IT is not yet seeing that growth. Harish, comment on tech and in India, and even the large cap versus mid caps, because while large caps is struggling, some of these mid cap companies are seeing growth, and there is a lot of optimism that the small cap companies in tech, which are very agile, they can actually become the mid cap companies in the next 5 years. So therefore, they're the ones to bet on.
Correct. So, Rima, you're right that a lot of the mid-cap and small-cap companies are doing better in terms of growth versus the large-cap companies. When you look at in aggregate for the sector, there's no issue with regard to TCV, ACV, which gives you a good indicator of how things should look like 12 to 18 months out. So those things are okay. The only issue is the conversion of some of these to actual revenue and actual growth, which is taking time. It's getting delayed largely because of the uncertainty that is prevailing at this point in time in US. A particular CEO or CFO is obviously going to delay some of the spending, which could be done in case the environment looks like it will continue to improve incrementally. So the uncertainty which is there at this point in time is leading to all the delays in decision making, which is also leading to delay in revenue flowing through for IT companies. We all are hoping and presuming that the tariff uncertainty, tariff noise subsides. CEOs have a clarity on what is the final tariff rates across the world, and then they can take concrete decisions not only on the IT spending, but spending across many, many things that they would be thinking of right now, where they're not taking a fixed decision to move ahead.
Harish, hi, good afternoon. You mentioned healthcare, right? Or do you mean hospitals, right? Which you're significantly overweight on.
We are positive across hospital, diagnostic, domestic pharma names in that order.
And I think I just recently came across the name actually. It's a recent listing, and I found Kotak as one of the shareholders. Very small company. I think some 1,200-1,300 crore market cap company, Kolkata-based hospital company, GPT Healthcare. I don't know how many hospitals they have, but do you want to just talk about it? The entire space has undergone a complete re-rating. The smallest market caps are the Delhi-based Indraprastha, and you got this one, which I guess is much smaller. I don't know if you want to address that.
No. So the thing is very simple here, that there are two things which are themes which are there for the next 5, 10, 15 years. Those are, one is when you look at the value migration, a lot of the tier 1 operators are taking market share away from tier 2, tier 3. A lot of tier 2, tier 3 operators are either closing down or selling those two tier 1 operators. So this is a trend which will continue for very, very, very long period in time. And this is largely because a tier 2, tier 3 hospital company, which was started by, say, 4 doctors who got old now, so they do not have the opportunity to continue, and they might sell it to a tier 1 operator. Second is this entire healthcare theme of more formal jobs, more insurance penetration leads to more tier 1 companies benefiting. So this is something which is far, far more structural in nature, will continue for many, many years to come. And in terms of the operating cash flow generation, if you look at the hospital companies, diagnostic companies, the EBITDA to operating cash conversion is 80 to 90%. So these are extremely high cash generating companies, which mean they do not need to raise capital to grow their business. Such businesses typically trade at high multiples across the world and will trade at very high multiples in India too.
Yeah, got it. The only risk sometimes I hear, which is not materialized actually, is we heard it, right? I mean,
Government intervention.
I mean, that's the big one. But I don't know. We'll see. So far, of course, there's been nothing of the sort. There's demand for quality healthcare right up there. We spoke with HCG, by the way, in the morning on Bazaar, and of course, we speak with other healthcare companies, hospital companies, regularly. Now, let's talk about another theme, right? Is consumption going to come back in a durable way? It's been capex, capex, capex. Then there was a break, and for the last 1 year, I mean, you can argue that actually neither capex nor consumption has done that well. Will consumption start to fire now? Nimish, you've looked at some numbers.
Yes, I've looked at some numbers, and this has been a big debate in the market as well in the last few weeks. That is this a time for a portfolio reset, and can consumption make a big comeback? So let me go to the wall and explain with some data as well as to why I'm saying this could be the time for consumption stocks to do well. So the big question that we're asking is this a time for a portfolio reset and a shift from capex to consumption? That's the big theme that's been debated as well. So first look at what the capex stocks or the capex companies have done in the last 4 years. So they've relatively outperformed, largely on back of the government push for capex, and that has been a big reason why all the capex related sectors have done phenomenally well in the last 4 years. So the chart will come up. This is the data for the last 4 years CAGR of the capex related sectors and all. So the big outperformers is the BSE PSU index is up 29%, the infra index is up 28%, the industrial index has been the biggest gainer, up 35%. This is a 4-year CAGR, and so is the likes of BSE capital goods up 33%, and even the utilities index is up 24%. So a mix of it, all these caps goods related indices are up between 25 to 35%. This is a 4-year CAGR for the capital good related sectors. Now, this is contrast to the big underperformance of the consumption basket in the last 4 years. They've done well, but they've relatively underperformed. The auto index in the last 4 years is up 24%, but look at the other sectors like consumer durables, FMCG, as well as oil and gas. They're up between 12 to 15, 16%. So that's the kind of performance we've seen in the consumption basket in the last 4 years. So relatively, they've underperformed the capex basket. But the question is, can they see a big pullback now? And can this be a year of, can the consumption basket see a big comeback? And what are the triggers to watch out for, and why I'm saying it can see a pullback? The first is the big shift in focus for the government in this budget itself from to consumption from capex via cut of the income tax. So that was a big trigger to watch out for. The second was front loading of interest rate cuts by the RBI this year. The third is good monsoon. It's been progressing well. And the fourth, but not the last one, is the big GST rationalization now seems to be a reality with the fact that the government is moving ahead and there's going to be big changes there as well. So these are the 4 triggers why a lot of people believe that consumption can see a big comeback. And to back that thesis, I was reading an interesting report from Bernstein, which came earlier this week, and they anticipate a great switch from capex to consumption in the years to come. So recently, they've actually upgraded staples to a mild overweight, and they've upgraded overweight to durables to overweight as well. So that's been a big strategy shift by Bernstein in terms of upgrading few sectors. Now within that, they are very overweight on QSR, retail and autos. That's a selective overweight within the consumption basket. They are equal weight on utilities. However, they are underweight on the industrial. So there is a big shift happening towards consumption from the capex side. So that's what even Bernstein believes. So the big question is, can the consumption see a big pullback? The big lesson from the last 4 years is that wherever government backs in, those sectors outperform. And now it looks like the government is focusing on consumption. So maybe it's time for the consumption to see a big pullback. So maybe you can ask Harish, if you've heard this data, you think, and you spoke about it, that you're a bit bullish on consumption as a theme. Within consumption, what are the few sectors that you'll be bullish on?
Sure. So across consumption, what we are doing is we are thinking through in terms of two lenses. First is we are thinking about companies where the SSSG, which is the same store sales growth, continues to hover in upper single digit or early double digits, and valuations are reasonable. And most importantly, the return on capital is high, which means that operating cash flow is good enough for sustained growth over the next many years to come. So that is one particular bucket. The second buckets are companies which traditionally have done well in the Indian market, but have struggled over the past few years. For example, some QSR companies where the probability of a mean reversion remains high. And these are very high operating leverage companies. So even a minor improvement in SSG could lead to a significant improvement in margin and operating cash. So those are pockets that we are looking at very aggressively. The third pocket are internet names where we are amongst the largest holder in two food delivery companies based on last published data. We clearly think that that could clearly continue to do well in the medium to long term, set aside near term where some of those have done well. So we don't know how those will do in the near term, but medium to long term, it should ideally do well. That said, I think consumption 18 to 24 month things look fine, but we need durable job growth. We need durable salary growth for the overall consumption sector or for the country to do well. So we'll also need to focus that beyond the near term for overall growth of the Indian economy and Indian consumption in particular.
Sure. Harish, with regards to the GST rate rationalizations, a couple of sectors like autos and consumers are expected to do well. At Kotak, any work that you all have done, which are the sectors which can be the biggest beneficiaries if this 28% GST rate cut has to fall to 18 or maybe even to 5%?
I think the two biggest beneficiaries at this point in time seems like the auto companies and the cement companies. Cement and both, obviously, we should hopefully see some demand improvement in this. In the auto companies, it's a direct correlation. A reduction in price leads to better demand. But when you look at cement companies, the flow through may or may not come through. It also depends on higher capital expenditure. So on average, these two sectors have a direct correlation. There are many other sectors or many specific pockets where we are seeing or we'll see some improvement, hopefully. But these are two sectors where we see a good improvement.
Harish, hold that thought. We need to slip into a very short break. We'll come back and decode the week's market action. And we'll also tell you about China's export story ahead of Prime Minister Modi's visit to China.